everyone. Welcome to another episode of Gray Matter. I'm your host, Leighton Gray. Um, we have another really interesting guest today. I get excited about all the guests that we have on the program, but especially ones that can come and give us very practical advice. I'm a pragmatist at heart, and the gentleman we have on the show today is an author. He's a financial advisor, but he's written a new book that just came out recently that's called Low Risk Rules. And it provides very practical, pragmatic advice to investors, everyday investors, about how they can grow wealth and preserve wealth. And so in the spirit of, having more diverse content, I know we talk a lot about politics and things like that on the program, but, we're also very committed to providing our viewership with information that's practical and that they can use in their everyday lives. And of course, today with what's going on in our economy, both domestically and internationally, being able to understand better how to grow wealth and to preserve it is obviously very vital. So I'm really excited about talking with Geoff Saab today about low risk rules. So before we go there, as we always do, we're going to frame our discussion with a few quotations, aphorisms, in honor of the man we have today, who is an expert in investing and finance. These quotations are going to be along or in that vein. The first one is from a very famous 20th century industrialist named Henry Ford, who famously was quoted. I don't think he wrote this down because it came out eventually that he was functionally illiterate, but I think he said this publicly. It is well that the people of the nation do not understand our banking and monetary system, for if they did, I believe there would be revolution before tomorrow morning. Modern sort of financial guru, the next one is from him, Mr. Ray Dalio. He famously wrote, and he does write often and very well, by the way, to make money in the markets, you have to think independently and be humble. And then finally, from Warren Buffett, the stock market is designed to transfer money from the active to the patient. And having looked a little bit at Geoff's book, I think his investment strategy probably leans kind of more in that direction. But we're going to find out because we're going to ask him a bunch of questions about his book and about how it can help people like us be better investors, more informed, more intelligent, more wise. But here we have Geoffrey Saab. So who is he? Well, he is vice president and portfolio manager with a firm called Doherty. He's been there since 2015. He's joining us today from Ottawa. We were just talking about how excited people are there about the second visit of the Truckers, Truckers 2. But Geoff is there. He's been there since 2015 after spending over a decade working exclusively within a multi-generational family office. Over 20 years of experience in tax, insurance, and investment management. Geoff believes that an investment plan is best implemented in the context of a wealth plan. Geoff prides himself on working with professionals, entrepreneurs, and their advisors to craft total family wealth solutions. He's also a treasurer for the Ottawa Branch of the Society of Trust and Estate Practitioners and serves on the Parish Council of a local church. Welcome to the program, Geoff.
Thanks, Leighton.
Wonderful. So you've written this great new book. I just bought it myself. I got through the first chapter, and so far very interesting. And but I bore it off of the internet. Just a description. Who's the book for? And it says here: entrepreneurs investing significant liquid wealth, family offices managing a public market portfolio alongside an enterprising active investment strategy, accountants, lawyers, investment bankers, and other professionals who would like to set their clients up for or after a business sale, or anyone who would like to understand the philosophy behind a practical, lower risk public equity investment strategy that preserves and grows capital over time. And it's advertised as a business-minded approach to wealth preservation. So I see here that actually, and bravo, it's as of yesterday was second on Amazon in terms of bestsellers in wealth management. So fantastic.
I'm surprised to hear that.
Yeah. So this is great. And I saw that this is a project that you had worked on for almost 2 years, and the book was just released last month. And I see that you've set up a website, geoffsaab.com, for people where people can go there, and I expect they can order the book and get more information about it. But where I'd like to start is with you. I gave a bit of a brief bio, but I wonder if you wouldn't mind just telling people a little bit more about yourself, where you're from, and your family. I know you mentioned off camera that your father lives in Ottawa, and you live there with your family. I believe you have 2 daughters, and you're married. Would you like to tell us a little bit more about where you're from, where you grew up, and how you got into being sort of an investment guru?
Yeah, so, well, I wouldn't call myself a guru, but we'll go from there. Born and raised in Ottawa, and don't hold that against me. Very fortunate, actually, because I think being outside of the kind of financial center of the country is helpful, because it helps you tune out a lot of the noise. It helps you focus on the bigger picture. And you mentioned Warren Buffett. I mean, he's located in Omaha, which is worlds away from New York City. Not just in terms of mileage, but also in terms of the style of life. So, yeah, my perspective, and I think as far as what's relevant to this book and what made me, I think, uniquely able to write a book like this is I haven't been an investment guy my whole life. So a lot of people might read this book and say, and, it's not terribly kind to the investment industry. A lot of people might read this book and say, well, this guy's just like taking shots at his competition. That's not really what it's about. I've been present in the financial industry in all sorts of places. So I actually started out as an accountant. I specialize in tax. I spent some time in the insurance business as an estate planner. I spent some time at another investment firm that had a different strategy when I was younger. And then for me, I think the real formative experience was 11 years spent in a single family office. And just so everyone understands, when we're talking about a family office, we're talking about a group of people that a wealthy family would hire to look after their own investments and their own planning. And so it's phenomenal, because what it allows you to do is work in finance at a very high level without having to sell. So it's quite nice in that sense. The perspective it gave me, so I've had this perspective kind of as an outsider in the investment business. So, when I was the accountant, I worked with other advisors on behalf of my clients. And then working in the family office, I saw how investment solutions were marketed to the wealthiest people out there. And I think it was very eye-opening, because as a chartered financial analyst, when you're hanging out with other CFAs, we have a very analytical approach to how we look at things. And it's very much a risk and return kind of evaluation. Oftentimes, families would have the person running their family office wouldn't necessarily be an investment person. It was often, if they sold a business, maybe their chief financial officer was the only financial person they knew. And it was more important that they trusted them. So they would bring them on, and they would become an investment manager of sorts. And so a lot of these families and a lot of these family offices ended up getting into investments that, to me, as the analytical guy, didn't really make a lot of sense. And I would go to, for example, the CFA conferences, and we would have a certain approach to building portfolios. And then you'd go to these family conferences, and you'd see a completely different approach. A lot more alternative investments, a lot more complex strategies, a lot more illiquid stuff. And the idea being that, and I think a lot of people feel this when they come into a lot of money, the rich are supposed to invest that way. And not only is that, I think, not the case, I think it's counterproductive. I think it's great for the investment business, and we can talk about why I think it's great for the investment business. But I don't think it's that great for the clients. I think ultimately what they end up in is in investment products that they're stuck in, they can't sell, that are very expensive, and that don't perform as promised. And I think a lot of it is hidden in this black box where assets aren't valued on an ongoing basis. You don't really know what's there. You don't really know what the manager is doing. And that kind of makes you feel good about it because you're not exposed to it every day. And meanwhile, your public market stocks are going crazy. So I think there's a little bit of an unfair advantage there to the illiquid stuff. But at the end of the day, I think people do a lot better investing in the same way. I call it old school investing. This is how my dad invested and how his dad invested. They got on the phone and they called their broker, and they weren't trading in and out. They didn't know what their stocks did during the day. And they certainly didn't know until they got the newspaper the next day how they closed, right? It just wasn't how things were done. And I think old school investing works.
Wow. So that answers kind of part of the first question I had for you, and that is, what was the impetus of writing the book? And it sounds like you wanted to reveal, or at least explain, another way of doing things as opposed to this commercial investment picture. So that's part of it. But I'm curious about the timing of you writing the book, because of course we're in this period that historically is going to be called, the COVID-19 pandemic. And it looks as though you got the idea to write the book right around the time the pandemic hit. So I'm curious about that. And that is, did the COVID-19 pandemic influence the content of the book, or your let's say your inspiration for writing it, or was that just coincidental?
It was somewhat coincidental, but the COVID crash was like my third crash in my investing career, like major crash. Mm-hmm. I was around in 1999, 2000. I was around in 07, 08, and I was around in 2020. And so really the book is collecting the experiences from all of those time periods. It's funny. I think sometimes it's better to be lucky than good as far as like the timing of the release. Mm-hmm. When I started conceiving it and figuring, okay, maybe I'll write a book, the book was intended to be specifically targeted to entrepreneurs who sold their business. I found myself working with a lot of people who were selling businesses just because the market was receptive and people were selling businesses for a lot of money. And I actually started down the road of collecting stories from people. And I mean, maybe that's going to be another book, because I got some phenomenal stories. Selling a business can actually be a really, really stressful time for someone. And I got some amazing stories around that. But I said, geez, if I'm going to collect all the stories I need for this book is not going to be out for a very long time. One of the things that I wanted to do when we saw how the market turned in late 2020 and into 2021, when we saw these bubbles inflating everywhere, having been around in 1999, I knew how this was going to end. It was just a matter of timing. And so one of the things I told my publisher when we started working on it was, I got to get this thing out fast, because if this comes out a year after the market crashes, no one's going to care. It's going to be like, well, no shit. Right. Mm-hmm. So it was really part of what I was trying to do was race against the clock to get this thing out before all these houses of cards fell down, right? Mm-hmm. These crazy expensive tech stocks, these cryptocurrencies, all this stuff. And, part of me was saying, I hope I'm going to warn some people away from it. I don't think it came out in time for that. And frankly, I'm not sure if they would have been receptive to the message at the time, because they were making too much money. They would have said, look at this old man who doesn't understand, as the crypto guys used to say, have fun staying poor. Shoes on the other foot now. But I think the whole story behind the investment philosophy that's laid out here is something that I wish I knew 20 years ago. Mm-hmm. I made a lot of money in the 1990s and I lost it in the early 2000s personally. Mm-hmm. And then I spent the next 10 years trying to find the next big winner. When, as I said in the book, I could have just bought TD Bank stock. Like I could have just kept it simple, and I would have done so much better. I think that too many people think they're investing to try to get rich. And that's a mistake to begin with. So number one, I think there's a message here around just taking a step back and, understanding what you're trying to do and understanding how you can put the odds on your side. The other part of it is speaking directly to the entrepreneur, because the entrepreneur has earned their success through taking risk. And they generally don't like to hear. I work with a lot of entrepreneurs that can be very difficult people to work with. And they generally don't like to hear that the odds are against them. They don't want to hear that because they really can't entertain that. When you're running a business, you can't focus on all the things that can go wrong. There's a million things that can go wrong. You just got to focus on what you have to do. Mm-hmm. The investment manager is exactly the opposite. So when I'm looking at a stock, I'm thinking of I need to think of all of the things that can go wrong, so nothing surprises me. So So it's two very different mindsets, the entrepreneur and the investor. And I wanted to talk to the entrepreneur in particular and say, you've made a lot of money by taking a lot of risk, and that's awesome, right? Now we're going to protect it by dialing the risk back. And by the way, and as you get into the later chapters in the book, I outline a lot of the research that has been done over decades that shows that counterintuitively, lower risk equals higher return. And everyone thinks more risk equals more return. And that's not true in the stock market. And that's been proven over decades of research.
Well, you're certainly speaking to me, Geoff, because in my partnership, I'm the one who gets accused of going off the cliff and always thinking we can build a parachute on the way down. Sometimes the parachute doesn't open. Sometimes the parachute turns into an airplane, and sometimes I land like Wile E. Coyote. But like Wile E. Coyote, we just keep coming back, and that's kind of the entrepreneurial mentality, right? But what you're talking about is something different. Like let's think. We don't have to go off this cliff. Let's talk about this, right? So you mentioned in your book, or you mentioned just now, part of why you were writing the book is you saw this sort of mass of contributing economic factors that were going to lead to something like a crash. It looks like that's what we're going through right now. In fact, and I want to ask you about this later, some people think maybe we haven't bottomed out. But my question for you before we go there is, what are the prevailing economic conditions, financial conditions that should be of most concern to investors, both domestically and globally right now? What are the big ones that you think people need to really be watchful about?
So I'm going to be careful answering this question because it's hard to answer. So we're starting to get into the realm of macroeconomic projections. And I'm not sure who said it. It might have been Peter Lynch. It might have been Warren Buffett who said, if you're spending, more than 10 minutes a year thinking about macroeconomics, you're spending too long. There's a lot of really intelligent people who have all sorts of theories that, inflation's going to be sustained, the cat's out of the bag, or a lot of smart people who think that inflation is just going to be a blip. Interest rates will come back down, inflation will come back down. If you're asking me what are the most important factors, I think that at the critical moment that we are right now, interest rates are very important because interest rates set the value of every asset, including stocks. Interest rates right now are driven by inflation. So interest rates and inflation become very important. Having said that, I have no idea what's going to happen to either one of those. I will say this. I think the job of the portfolio manager isn't to predict what's going to happen, and it isn't to take big bets, but I think it is to evaluate the range of potential outcomes and position accordingly. So, I consider my job to be to protect the capital of my clients. And so when our investment committee was sitting around the table in 2020, we were seeing the monetary and fiscal stimulus that was being pumped out, and realizing that despite what central bankers were saying, inflation was a real risk. Once everything reopened. Now, no one knew it was going to take 2 years. I think people were thinking more like 3 to 6 months. The problem is the longer it dragged on, the more stimulus was poured on, right? And so that when we reopened, and we're not even fully open yet, and we're still seeing all sorts of inflation. I think that, we considered our job back then to guard against that, but it wasn't a prediction so much as it was just kind of looking at the universe of assets and saying, other investors don't seem worried about this. We think they should be. You could make the argument now that everybody might be too worried about inflation and that you might want to lean the other way. I don't know. And I'm not going to, make a prediction or a call on that one way or the other. But I think what's important at a time like this, and this kind of goes back to what I talk about in the book, if you want to preserve and protect wealth, the things that you think are safe might not actually be safe. Like buying a GIC or a government bond that a year ago was paying you under 1% did not protect your wealth. Your purchasing power is down 10% right now, right? On that safe investment that you bought. So over the long run, the only way to preserve your purchasing power and your wealth reliably is to invest in common stocks, common equity. That's my belief.
Mm-hmm.
Then you can think of what's the best way to do that? Well, the best way to do that is to think about it not like, and here's where I think a lot of people, there's an adjustment. People talk about investing in stocks, and they look at the market and they look at these charts and they look at the line going up and down. And to them, stocks become like a casino, and they buy something because it's going up. I'm saying, no. Let the other guys invest in stocks. We're going to buy businesses. We're going to build a portfolio of businesses. And so now when we talk about creating a portfolio that's going to withstand whatever comes down the road, inflation, deflation, whatever it is, we're going to own businesses that we feel are high quality assets and very well managed that will ride it out. That doesn't mean the stock price isn't going to fall tomorrow or next month or this year. It just means that over the long run, we believe that management is going to make the right decisions and earnings will grow, because that's what happens. Mm-hmm. It's important to stress, and I'm writing to entrepreneurs in this book and talking to entrepreneurs and business people, because I think this resonates with them. Because at the end of the day, when you're investing in stocks, the finance guys, like the finance geeks, look at it as an asset class, and they look at historical real rates of return and all this kind of stuff, and what's the equity risk premium. And I'm saying, forget all that. When you're investing in stocks, you're investing in businesses. You're investing in the people running those businesses. You're investing in innovation and ingenuity. You're investing in that. That when you put that up against inflation or trying to predict what the central bank's going to do or whatever else, that's going to win over the long term, provided you made the right decisions and provided you didn't pay too much. And I think that's what people are discovering in the last 2 years. They paid too much. They were too optimistic about the future prospects for too many businesses.
Mm-hmm. So I think most people would get this sort of ant and the grasshopper kind of mentality that you're talking about. But your book talks about rules. And so I expect that there are some rules in the book. I think you've just sort of hinted at one of them, and that is one of the rules, it sounds like, is to invest in companies based upon their fundamentals versus trying to time the markets. Is that one of the rules?
So,
so could you give us a sort of a sketch of what some of the basic rules are from the book?
So buy businesses, not stocks, would be a rule. When I started to write it, I didn't want to just number rules because I thought that was a little bit cheesy. And then my first editor
did very well with that, though, Geoff.
Yeah, my first editor said, no, you have to have rules as your chapter. So I actually have the last on page 251. There's just the rules, and so I think you can split them up into a few groupings. I talk about letting your purpose guide you in terms of your wealth. So when you're very wealthy, if you're just watching the value of your portfolio go up and down, you're going to drive yourself crazy, right? It just because, especially if you had a business and now you've sold it, and if your portfolio is becoming like your hobby, you're not going to do well. Because entrepreneurs are antsy. You want to do something, right? You don't just want to sit and watch your account balance go up and down. So your bias to action is going to force you to do things, and you're going to make mistakes. I talk about humility. Going back to one of your first quotes, I talk about acknowledging the role of luck and how it got you here, and realizing that now we need to take a lot less risk with the portfolio because we don't know what the future holds. Mm-hmm. I talk about approaching your investment portfolio with business smarts. Just basically, I see so many smart people who just kind of, they don't think critically when they're evaluating an investment product or an investment sales pitch, and they should. Mm-hmm. I talk about ignoring the crowd and being a maverick, and entrepreneurs should be good at this. But yet, when it comes to the investment portfolio, we're not. We see other people getting rich, and we want to do the same thing. Mm-hmm. I talk about knowing the difference between investing and speculating. I'm sorry to say, but if you were buying cryptocurrencies, you were speculating, right? If you were, and it's not to say that Bitcoin might not be around 50 years from now and be worth more than it is today. It might be. I have no idea what the future holds. But I think when there's an overwhelming amount of optimism around an asset, you really need to be careful about like there has to be something grounding your estimate of value, and a business person would know that. I think we lose a lot of this critical thinking, and so there's all these. There's more to it. I don't want to give away all the whole plot, but really, kind of that's the idea. Is let's approach our investment portfolio with the same mentality with which we approach our business.
Mm-hmm. So it sounds like some of the strategies in your book, if I'm hearing you correctly, would be available and should be available regardless of whether or not we're experiencing a bull or bear market. Because what you're talking about is, and you talk about low risk, which doesn't sound very sexy, but what you're really saying is when you say low risk, it's built to last. It's not something that, even though there may be fluctuations in the market, if you have this low risk strategy, if you employ this low risk strategy, you will win over the long haul. Is that essentially the idea?
You're putting the odds on your side,
right?
I don't know if you're going to win because the future is uncertain, but I think you're putting the odds on your side. And I use a lot of analogies around gambling to illustrate that, because I think that we intuitively understand it. We understand that a coin flip is 50-50, but we don't understand that when we're buying a company, it doesn't matter how fast it's growing, but when we're paying 40 or 50 times revenue for an unprofitable company, the odds are against us. Like we are paying a lot for this very small probability outcome that will be correct. And Canadian investors know this better than anyone else. Look at Shopify, right? Look at our history of the largest company in Canada: Nortel, Valiant, Shopify, I think Research in Motion at one point, BlackBerry. Like, I think if you look, you kind of look at all these false promises and these very over-optimistic projections that we continuously get sucked into or buy into. That's a good example of basically like you're making a long shot bet. And all I'm saying to people is just bet where the odds are on your side. And generally that involves putting bets down on the horses nobody else is betting on. Like, and I link it to horse racing because I'm a newbie and I go to the track, and who are you going to bet on? Like, I want the longest odd horse. I want the guy with the really cool name. Like, I don't know, but I'm certainly not looking at the statistics in any detail, trying to understand where my money's going to go. That's how most people buy stocks. Most people spend more time researching like their fridge or their TV than they do the stock they buy.
Right. And so part of the issue is, and I want to get you to maybe explain how people can do this, because the market that you've been talking about for financial services seems to be geared towards this sort of hands-off situation where, you hand off your money to a financial investor or a financial manager, and they just go off somewhere and they do something with your money, and then once a month you get a statement. But what you're talking about sounds like it's more of a hands-on approach where the individual would have to either invest their own time, pardon the pun, and energy into learning about these companies the way you say it, or else find someone like you who's actually familiar with this low-risk strategy. But it doesn't sound to me like, and correct me if this is wrong, it sounds like people like you are sort of swimming against the tide of the trend of what's going on in the financial services industry.
Well, there's a lot in there. So, first of all, in terms of should people do it themselves, I actually think most people shouldn't do it themselves. They're not trained. Like, here's what I think. There's also when you're dealing with money and when you're dealing with a portfolio, there's an emotional component as well. And it's whether you're investing your own money or someone else's, your approach is different. My approach is different in my portfolio versus my client's portfolio. Just my risk tolerance is different. I think that if you're investing your own money, you tend to be a lot more reactive to bad news. You tend to, I think, focus too much on the loss. And I talk about prospect theory in the book, like from Daniel Kahneman. And his research, and basically, people are very loss averse, and losses hurt more than gains feel good. And so I think there are behavioral finance reasons that most people would not want to invest for themselves. I'm also writing the book. I think I'm writing the book more for the wealthy investor. And I think the wealthier investor should hire somebody because there's a lot at stake. So hire some professionals who know what they're doing. Now, when you talk about the kind of at the lower end, I think that the investment industry it's not built to serve smaller investors well. And this is a bit of a tragedy. And when I say smaller investors, I'm talking about portfolios of, less than $500,000, for example. I think that, you go to your bank branch and they'll sell you some funds and you're probably paying too much for them. You might be paying 2.5% or 3% in fees. That's what it used to be. I don't know what it is today. And that makes it really hard to make money. I think if you're in your earning years, you don't worry too much about that. You worry more about adding to the pot. And then I think you look at things like index funds. I think you look at things that will reduce your costs. Then when you start to get into kind of that $1 million and up range, then you can start saying, okay, now we're going to start looking at individual securities. We're going to start looking to hire somebody who's going to implement a strategy for me. And that's where, and there's lots of portfolio managers who do this kind of very simple, like meat and potatoes, low risk strategy. There's a lot of us out there. And I say in the book, it's more art than science. Everyone kind of wants this solution, like even the strategy that you're talking about. I'm leaning on research that is based on numbers and historical return data, but I'm not using it in how portfolios are managed day to day, because I think that any automatic approach to investing is going to it's going to be easily replicated, and it's going to, as soon as it gets too in fashion, future returns are not going to be very attractive. So, I think here I am talking to the person who's amassed more, who has like a 7-figure plus portfolio, and I'm saying, hire somebody, but be careful who you're hiring. So what I'm saying is the low risk strategy and the very simple strategy is one that focuses on buying really good businesses and holding them for the long term. And it's not complicated. I think, and here's where this segment of the market is not served correctly, is they are told that they cannot make money or protect capital without buying the hedge fund, without the private equity allocation, without the art allocation. Like there's all this kind of crazy stuff that people start putting into portfolios. A lot of them will also, they'll say, we're gonna build you a diversified portfolio of, the best managers in this area and that area. We're gonna get you the best emerging markets manager and the best large cap manager and the best small cap manager. And again, and my book illustrates this, there's layers of fees involved in all of this that even if they could do it, I don't think they can. I tried to do it in the past and it's very hard to do. It's actually harder to do than buying individual stocks. You add onto that the layers of fees and everything else, it's just not worth it. So I think that, what we do is it's seen as very unsophisticated. It's like you just buy stocks and bonds, like just long only investing. It's seen as kind of very elementary and unsophisticated and beneath the successful, wealthy investor and beneath the family office. And I'm like, guys, here's the research. Like, this is all you need to do. And when you talk about Warren Buffett, that's generally all he did. I mean, there's a little bit more involved with him, and he's a businessman, not just an investor. But I think, the core of the philosophy is basically partner with excellent management. They're going to manage your money for you. And so here's kind of the thing that the asset allocators will tell you. They'll tell you, I'm going to hire the best money manager for your portfolio, and we're going to put your money with them. And I'm saying, I can't predict who the best money manager is. Even if their past numbers are really good, their future numbers might not be good at all. I don't know. But here's what we're going to do. We're not going to hire the best asset managers for you, like the best fund managers. I'm going to hire who we think are the best corporate managers, right? Evidenced by things like their margins, their stability of their revenue and their income, and the solidity of their balance sheet. And I'm going to let them manage your money for you. And so the philosophy changes. All of a sudden, we're not hiring the asset managers to manage your funds. We're hiring the corporate management. And so when people even say to me, when people are commenting about their portfolio performance, and we've held up a lot better than the market this year, because a lot of what we've seen, the turmoil in the market, has been in those higher growth, higher risk areas, and the more stable stuff has done quite well. When people comment about that, I say it's just like the market doing what the market does. It's not me. We gave the money. We decided to allocate the money to these very strong companies that are well managed, and more often than not, they'll perform well. That's not always going to be the case. You're going to have some stinkers. You're going to make mistakes. Unknown things are going to happen. The company's going to get sued because something happened with one of their products. This stuff happens, right? But I think if the philosophy changes and we talk about, as an entrepreneur, I'm hiring other business people to manage my money for me, then I think the conversation changes. Interesting.
What you were saying about hiring an advisor reminds me of an adage that applies to lawyers, and that you might have heard this, that a lawyer who represents himself as a fool for a client. So the same might apply in this case. Okay, so we talked about wealth generation and about how to wisely accumulate a fortune. Let's talk about preservation. We had a guest in this program not so long ago named Kim Moody, who is a tax expert. And he said something that really struck me, and I wonder what you'd say about this. He said the most expensive thing that we will ever purchase is our taxes, our tax liability. So talking about preservation, once you help people generate all this wealth, how are we gonna preserve that so that Mr. Trudeau and company, don't come and scoop it all and spend it on things that we won't discuss on this program.
So Kim Moody knows what he's talking about. And we're both members of STEP, and I saw him speak recently as well at the conference last week. I was a tax accountant in a prior life. That's how I started. The way I look at tax, and I've said this to my clients, it's almost similar to, and I don't give tax advice now. I think it's important to know I do not give tax advice. And I'm very adamant about that because I understood taxes really well 20 years ago. I understand the devil's in the details. And so this is not tax advice in any way, but I think just kind of as a formula of how you think about tax planning. Tax planning is too often overlooked. And it shouldn't be. As an investor, you care about what goes in your pocket after tax at the end of the day. So problem is, a lot of investment strategies, they might be designed for institutional investors, not for taxable investors. And so when your multifamily office puts you in these institutional quality products, your tax bill might be higher than it otherwise would be. I think in the work that we do on an ongoing basis, because we kind of buy companies and hold on to them, it tends to be a lot more tax efficient than a lot of other options. But when you're looking at things like hedge funds, when you're looking at things like foreign assets, being aware of the ultimate tax liability that you pay is tremendously important. And I've seen too many times that attention hasn't been paid by the investment advisor. The other thing is little, small, tiny, seemingly tiny mistakes can cost a lot of money in tax. I had a client come in, and it was something as simple as the advisor hadn't asked the right questions and had opened her new account in her personal name instead of her corporate name, and basically effectively had dividended all of her assets out to her personally. So she would have been responsible for dividend tax on an extraordinarily large amount of money that year. Fortunately for her, she transferred her accounts over to us, and we caught the problem, and we repaid the money and made sure that there was no tax owing at the end of the year. Things like this happen, and they happen because advisors are not trained in tax. So it's very dangerous, especially for the wealthy client. If your advisor doesn't have a tax background, that's fine. Not all do, and taxes, it's a whole other can of worms. Make sure that you have someone with tax knowledge who's watching over what's happening. So it's a matter of missing opportunities. It's a matter of making errors. And I always say to people, as far as tax planning goes, you generally want to. There's a lot of tax planning pitches out there that involve some let's call them creative strategies. I generally advise against them. Reason being, once you've kind of ventured into that gray area, if you've been assessed by CRA and, the assessment's gone against you, they're going to be on your back for a long time to come. And it's generally not worth the hassle. It's kind of, I say taxes, it's almost like investing. Is the risk worth the return? Mm-hmm. And generally speaking, it's not. Generally speaking, it's, pay your tax. Let's arrange your affairs in such a way that we can minimize everything. I think a lot of people, especially now in the situation we're in, I'm hearing stories. I know one in particular, and I'm hearing from other lawyers that I know in particular, many people in the last 5 years plus have been leaving Canada, and it's purely a tax motivated thing. Mm-hmm. And, I think we've kind of reached the maximum tax rate that is going to be tolerable for a lot of people, or the drain's going to continue. And I think that would be tragic. I call entrepreneurs in my book, I call them the heroes, because without them, we don't have the businesses, we don't have the jobs, don't have the products. Like, think about everything that they contribute. And I think that we shouldn't be taking their profits. We should be thanking them for the work that they've done. And too often, we find ourselves in a situation where we're going out of our way to try to preserve what they've worked so hard to build.
It sounds like we could use you as our next finance minister. One of the things, speaking about, the low risk rules. A lot of people talk about, I guess people like me who know as much as you do about these things. We're always being told, or we talk about things like diversify. So is part of the low risk rules strategy that you would own different types of asset categories, like say, for example, land or, commercial real estate or precious metals or things like that? Or do you try and steer people away from that? Is that not part of the low risk rules strategy because some of those things are more speculative?
Great question. So there's two offsetting forces here. There's diversify, but there's also sorry, we gotta I lost the thought there.
That's okay. We can edit out any brain crack.
Yeah, we're gonna have to. So on one hand we're talking about diversifying, and on the other hand we're talking about simplifying. There you go. All right. Great question. So there's two elements to that, right? There's making sure you're diversified, but also simplifying your portfolio, also not having too much complexity in it. And those are opposing forces. They sometimes work against each other. Mm-hmm. So part of the low risk portfolio is you're going to diversify. So I talk about this in the book. You made your money by generally being concentrated in your own business. So now it's time to diversify. Okay, that's good. The other thing we want to do, though, is we want to understand that more complexity in your portfolio isn't necessarily going to add to your returns. So we want to keep it as simple as possible. There are certain characteristics. There are certain assets that I think I'd prefer to get exposure to them in public markets, through public markets, right? So, I'm not a gold bug, but if a gold producer is is trading at a low valuation, is generating good cash flow, is buying back shares, paying dividends, I'll take a look at it. I love real estate. I think real estate is a phenomenal asset class because it provides you with cash flow, certain degree of inflation protection, a hard asset, right? Kind of the same things we want out of our businesses, right? Mm-hmm. So I think and even within real estate though, there's development, which is very risky, and I would probably caution a lot of people against. And then there's, owning a residential building and collecting rent on that, which can kind of almost be considered like a bond. So I think there's a huge continuum there. I think it depends on the person. It depends on how active they want to be in managing their portfolio. Like, I'll manage the stocks. So you want to You want to have some real estate? All right. So we'll consider that as part of the overall allocation, but are you going to hire a property manager? Are you going to do it yourself? How are you going to build that into your portfolio? How are you going to finance it? Those are the kinds of questions that we can consider. All of that within that low risk framework, right? So I think that too many people are drawn to complexity, which, and you'll get into this, I think it's in the 3rd chapter of the book, where I talk about how that's our default. Our default is complex. We think that that's a better solution than what's simple. So we're drawn to that. But I think there's also this idea that the more you own, you kind of it's easy. And so as a professional asset manager, a lot of them are going to try and throw all sorts of different stuff in your portfolio because that's going to hide the volatility. Right? There's so many things you can invest in. You can invest in timberland. You can invest in farmland. You can invest in and I'm not saying they're not good investments. You can invest in art, cars, wine, you name it. There's a fund for it. And if you own enough of these very different types of investments that are not valued every day like stocks are, it'll kind of dull the reaction of your portfolio. And that's great for the asset manager because then I send you your statement and you're not complaining because it's down. But it could be costing you a lot more in the long run. So I think that when we talk about the low risk philosophy, it's that balance. It's that balance between, diversifying your bets and reducing your risk that way, but also not overcomplicating things. Mm-hmm. And it really is going to depend on the individual.
Interesting. So one of the things that I've found is that the best books are worth rereading, and hopefully Low Risk Rules is going to fall into that category, and it'll become an all-time Canadian classic. But there's a book that I recently reread, and I think it's at least the 3rd time I've read it. You're probably familiar with it. It's called Think and Grow Rich. It's a Napoleon Hill classic. I think it's 100 years old this year, I think. And it really isn't about getting rich. But what I'm hearing from you, Geoff, and maybe you'll dispute this, but some of the principles in that book I'm hearing in your investment approach, the idea of thinking in terms of abundancy, thinking about, for example, learning about investing in good businesses with sound fundamentals, things like that. The other thing, though, and this is a little bit counterintuitive, and I want to ask you about, I'm not sure whether this is in your book because I haven't gotten that far yet. One of the things that is in Think and Grow Rich, which was sort of an anthological study of, these sort of very, very rich, fabulously wealthy figures of the American Gilded Age, people like Andrew Carnegie and Mr. Mellon and Henry Ford and people like that. One of the things that was very surprising to me, and I think would be to a lot of people, is how generous the very wealthy are, so that they actually build philanthropy into their wealth strategy. It's an essential part of it. And in his book, Napoleon Hill explains why this is very important. It's psychological, but it also has to do with a person's spiritual approach to life. Is that part of the low risk rule strategy, that this idea that, and I know it's counterintuitive because people want to collect money, they don't want to give it away, but is that part of the low risk rules strategy that is part of a sound investment strategy? You would have some part of that you would build in as charitable giving?
I covered early in the book, and I didn't spend enough time on this as I should have, because it's really another book in itself, number one. And number two, I don't feel anywhere near qualified to have this discussion with people in book form. Yeah. I don't feel like I'm there yet. But I think that in my experience, at least, the people, when they've got more wealth than they're going to need in their lifetime, you almost need to forget that it's there. And what I mean by that is, don't focus on the money, but focus on what purpose it has in your life. So being very wealthy it opens all sorts of doors for you. It gives you opportunities that other people do not have. So if you think in those terms, all of a sudden that lump of money that you have, it's not about the investment returns. Now it's about what can it do for me longer term? And I've seen clients do like really amazing stuff that, ordinary people would never have the opportunity to do, or give their children opportunities that people wouldn't be able to do, or give back in a way that really makes a real difference in an area that is meaningful to them. It's something that, and particularly after somebody sells a business, I think that there's this seeking of what's next and what's the purpose and where am I going to direct my energies. And what you've got when you're talking about entrepreneurs, you're talking about people who make things happen, who are generally quite exceptional in the way they approach things. Man, like we need that. Let's unleash that. So I feel like part of what I'm trying to do is allow them to take their focus off of the portfolio and focus more on, all right, how can we use this wealth to make the world a better place? And, if anyone is familiar with the New Testament and the parable of the talents, that's been I think one of my driving things is to help my clients make the most of what they've been given. It doesn't matter whether you've got 1 or 5 or 10 or whatever that number is, but to make the most of what you can do with that. That's everything. That's how you live a fulfilled life. And really, ultimately, what we're talking about here is, let's forget all the crap. Let's not worry about what the market's doing today or what it's going to do tomorrow, right? Let's invest in a way that makes sense, timeless principles. We know it works. And let's kind of focus on these things that really, truly matter and are really going to fulfill you and your family and leave a legacy, right? I think there's so much more to this business than investment returns.
So really, low risk rules, part of what it tries to teach is to think differently about the concept of wealth. And that brings me to another question. And maybe this is one, will put you on the spot a little bit. It's my impression that retirement is sold to Canadians very much as a destination. It's almost like it's a place that you arrive at, and it's sold as a product. And there seems to be almost an aspect of fear attached to it. The slogans like, you're richer than you think. Well, I don't know how rich I think I am. What does that mean? Of course, Scotiabank, to their credit, is at least starting to criticize our Prime Minister's financial manager, which is refreshing. So I should give credit where credit is due. But my point is part of what you talk about in the book, these low risk rules, also designed to get people to start thinking differently about retirement, as opposed to this idea that it's a destination where we arrive and freedom 55 or whatever, if you're old enough to remember that slogan, and to think about wealth as something that is part of life. It's a pursuit. But it's not a destination, and you shouldn't be looking at wealth accumulation and preservation in order to achieve this result of retirement. Do you see what I'm saying?
100%.
That seems kind of wrong-headed. Would you agree that that's kind of a wrong-headed way to look at investment?
Somewhere on my hard drive is a chapter that didn't make the cut that has to do with that very thing. I think the whole concept of retirement is bullshit. I think people have been.
You really think, Geoff?
Yeah, well, that's how I wrote the book too. I don't think most people, like, there is this a promise that's been put in front of people, right? It's like, and our industry has been guilty of selling it to a certain extent, right? With all of these advertisements of people on the beach and on their boats or whatever. I mean, yeah, sure. Some people really want to. They really want to golf every day, and that's fine. Like, that's cool. But I think a lot of people have kind of bought into this idea that that's what they want, and then when they get there, they're not happy. And in particular, when you're talking about a business sale, and a lot of the people I talk to, one person made a really memorable comment to me, and it was very stark. And he said, "The 6 months after I sold my business were the most miserable 6 months of my life." This is a guy who's he's been divorced. The business sale was was the hardest part for him. And there was research that I read when I was working on the book, that the entrepreneur, like you do an MRI, the same parts of your brain light up when you're talking about your business as does when you're talking about your kids. Like there's an emotional element to this. And I think what it is, and psychology will back this up, is that you need a purpose in life, whatever that is, right? And I think that the people who are happiest, and this is linked to I think what we're talking about as far as philanthropy goes, is figuring out what your next 40 years are going to be, right? Like our life expectancies are going up. You could realistically have, if you retire at age 60, you could realistically have another 30 good years, right? Or up to, like, you can have a long time left where you can travel and do things and be active. And so that's a long time. So I do think that we've done a disservice to people saying, save up all your money and then we're going to start drawing it down. And a lot of people have trouble with the drawing it down too. The people who I deal with who are most engaged and happiest, they still have things to give back. They're mentoring people. They're on corporate boards. They're actively still in it. What I joke with one of my clients who is retired, that he's the busiest retired guy I know because he's still working 7 days a week. Right. He retired. Right. But he's doing it on his terms. And I think that's the difference. Get to the point where you can live life on your terms and forget this notion of retirement in my mind. Now I'm biased. I've told people I'm never going to retire. I'm hoping I'm going to be doing this when I'm 90 years old. So I'm giving up my bias here. I
hope you write a lot more books. One of the best stories I've heard along this line was from a book I read. It was a biography about the life of Michelangelo, who died when he was 91. And he was still incredibly fit. And they found him on the floor of his studio with a half chiseled piece of marble and the chisel in his hand. And that's how he went out trying to create another work of art. And
what a way to go!
That's a life well lived, That's it. And I think of the sort of people who you deal with, that's the mindset, as opposed to this, I've got to get to retirement and then everything will be okay. And that really that's a fallacy. No matter what you're thinking about in terms of life, there's no destination. The whole thing is a journey. We don't know where it's going, and that's why it's great. Anyway, this has been a real pleasure talking to you, Geoff. Thank you for writing your book. I'm looking forward to reading the rest of it. Now, if people want to learn more about the book and about your investment strategy, I know we've got the website, geoffsaab.com. We've also got the website for your firm. Are there any other places where people can go where you'd recommend so they can find out more about low risk rules and about the work that you're doing?
Well, I think the website is the best place to go and spend some time with the book. And I think so. What I really do in it is, and it's not technical. I've had 2 people say to me in the last week, and I think it's the most flattering thing they could say is it felt like they were just having a drink with me. And that's what I was going for. I did not want to write a marketing piece. I did not want to write something that, bored the non-investment person. I wanted to kind of poke at the hornet's nest a little bit. That was on purpose. So I think, if you spend some time with it and you enjoy it, then reach out and we can continue the conversation.
That was one of the things I wish I had mentioned. As I said, I just read the first chapter yesterday in preparation for talking with you, and I do read a lot. I probably consume about 3 books a week, and one of the things I noticed about your book was that very thing, is that it doesn't read like a technical manual. It has a kind of a journalistic flow to it, which is wonderful, because I think you're going to reach a very broad audience. I love books. And really, that's what we tried to do on this program. I love books that assume the person who's reading is intelligent and is engaged in the content. And just from the first chapter, you have my attention, and I want to read more. I'm looking forward to reading the rest of it.
I appreciate that.
Yeah, so we're at the point, speaking of the reading list, by way of segue. So where we finish off this program, first of all, I want to thank you for your time. We're very grateful for it, and you've been so generous with your knowledge. And I know anyone listening has really benefited from that. But this is a point of the program we call the reading list, where we try to point people to other resources, whether it's a book or website or anything like that, where they can kind of go and explore further aspects of the conversation we've had with you. So obviously, one of the books, I'm going to go first, and I'm going to give you the final word. One of the books that I'm going to recommend, surprise, surprise, spoiler alert, Low Risk Rules, a Wealth Preservation Manifesto. I should have asked you about that. Why manifesto? I mean, why did you? Because let's face it, manifesto sort of has that whole Marxist ring to it.
Yeah. We're taking it back.
Why was that your idea or the publishers, or?
That was my idea. Leighton, we're taking that word back.
Okay.
We are standing up against, I think, an industry that does not serve its clients properly.
Mm-hmm. Mm-hmm.
And I think that the people who often end up paying the most for that are the people who have the most. And that's not fair. It's not fair, because I think that there's a lot more that they can do with that. And so, yeah, like I said, like I'm the whole point was to get some attention and make a ruckus. And I guess that's what the word does.
The manifesto, in the sense that it's partially, and you've been full disclosure, it's a bit of a protest of the way that financial services are sold to people, right?
Yep.
And of course, so let's face it, I brought in Marxism. That was a critique of liberalism, right? And that was why he called it a manifesto. But unlike Marx and his ideas, yours are clearly not metaphysically evil and designed to destroy the world, which is great. The second book that I'm going to recommend is one that I read recently. It's one you might have read too, Geoff. It's called Investing Made Simple. It's Warren Buffett's strategies to building wealth and creating passive income. And this I found, again, was one that was very readable. It was designed for people who were newbies to investment. And it really, I thought maybe is a good companion piece to the work that you've been doing, because it has the same idea. It's designed to sort of usher people into the building, to get them thinking about wealth, how they can build wealth and how they can preserve it. And so that's why I mentioned it here. And it sounds like there's a lot of concordance between your thinking about investing and also Mr. Buffett's. So with that, I'm going to turn it over to you. And are there any other sources that you can point us to besides your own book?
Well, I'll throw out, if anyone is kind of interested in the do-it-yourself approach or really wants to understand how it's done, the one book that turned the light switch on for me, and I read it in university, was The Warren Buffett Way by Robert Hagstrom. And the great thing about that book is he kind of walks through all of these companies that Warren invested in and the logic behind it and the numbers behind it. And I think it's really a way that if you read that book and it resonates with you, you get value investing. If you read that book and it doesn't resonate with you, all right, that's not a strategy that you're going to have conviction in. And that's something else we talked about in the book, was conviction. Mm-hmm. But I think Warren Buffett Way, from the investment perspective. The number one book, though, is not an investment book. And I think that I give this some thought. The one book that I return to time and time again is Meditations by Marcus Aurelius.
Oh, yeah.
And I see so many connections between that book and how it's shaped my investment philosophy and my approach to everything, really. But when you think about the concepts we talked about here, focusing not on what the market's doing and other people are doing, focusing on yourself, right? Acknowledging the role of luck or fortune or the gods or whoever, Marcus Aurelius talked about the gods and what they had in store for you. Acknowledging it and accepting it for what it is, focusing on things that are eternal versus temporal. Right. Mm-hmm. The market's going to go up and down today. But I don't care. Like if, Warren Buffett used the example of Coke, people are not going to stop drinking Coke. Right. And I'm not telling you to buy Coke stock because it's quite expensive. But but that's kind of the example I'm talking about. Let's kind of keep our eyes on the longer term. and let's, you know, have that harmony with nature, accept what the market is giving you. I think that people who are trying to fight against it, people who are trying to get rich quick, or people who are trying to continue to invest even after they're rich, as if they're trying to continue to get rich, I think they're putting the odds against them. So really, it's this kind of very Zen, stoic approach to investing and building a portfolio.
Oh, I could see Marcus Aurelius and Seneca and some of the other Stoics really sort of signing on to the idea of low risk rules. I think that would fit squarely in there.
I think I may have just thought of my sequel.
There you go. Wonderful. Well, again, thank you so much for producing this book. I know it comes at a great time for many Canadians who are very concerned about what's going on financially in the world and economically, and it's a feeling generally of I sense great powerlessness. People feel that, and of course, what do the Stoics say? The solution to that is the pursuit of knowledge, right? Knowledge and wisdom. So it sounds like that's what your book provides. So we're very grateful for that, and also for your time today. It's been a real pleasure talking with you, Geoff. I wish you much continued success with the book, although the way it's selling, it sounds as though even though you value luck, your book sales won't need it.
Well, I'm very surprised and pleased to hear that. So, but thank you for having me on. I appreciate it.
Thank you very much.